Well, hello there, Parallax traders. This is Imre, and welcome back to another YouTube video. This video, I'm going to be focusing on the subject of secondary indicators. Are they good? Are they bad? Do you need them? Are they helpful at all? Can you build trading strategies around indicators? We're going to get into all of that. So I'm going to say first off that whether you use indicators or not does not have any bearing on its own as to whether you will enjoy consistent success as a trader. You could use all the indicators in the world or none of them. I don't think that's the make or break factor that's going to determine your trading success. What I will say is that indicators have their pros and cons, and they're just tools at the end of the day. That's all they are. They're just a set of tools. So whether you're looking at moving averages, Bollinger Bands, RSI, MACD, it doesn't matter. They're just tools. And here's what I know about tools. If you don't use the right tool for the right job, then you're not going to get the job done. And that's the number one mistake that I see people make when it comes to technical indicators, is that they don't really understand the tools that they're using. Therefore, they have no idea whether or not it's the right tool for the job. So a very easy example would be moving averages. Moving averages perform very well in a trending environment. However, when the market is choppy, when the market's going sideways, they're not really all that helpful. So I'm going to give you an example. We're going to take a look at some sideways chop here in the dollar index. So if I drop down to a 2-hour chart, you can see we have a number of moving average crosses. We have a cross there, we have a cross here, bearish cross there, and so on. You can see the other crosses. Now, I'm not going to sit around and say, yes, if you traded each of those crosses, you would have made money, or if you didn't trade those crosses, you wouldn't have made money. I'm not going to say that one way or the other. I don't really care. What's pretty obvious to me, however, is that in a trending environment like what we see in this large rally, this moving average cross would have been incredibly profitable. On the other hand, you probably would have gotten chopped up at least a couple times trading moving average crosses during this sideways period of consolidation. So again, it's not that the moving averages are good, it's not that the moving averages are bad, it's just that you have to understand which tools are right for which job. You have to understand which tools perform most optimally in certain market conditions. Okay, now I'm going to bring the wave principle into this at some point in time. So here's what I have to say about indicators and the wave principle. What I love about the wave principle is that it works in every market condition. Doesn't matter if it's a trending market or a sideways market, bull market, bear market, it doesn't matter. The wave principle is simply an explanation for market behavior. And so it explains market behavior regardless of the set of market conditions that you are dealing with. The other thing I love about the wave principle is that time frame is irrelevant. I get asked all the time by Elliottians, what time frame should I be looking at the market on? And I say, I don't care. It does not matter. The time frame is irrelevant. You pick the time frame that allows you to see the price action the most clearly. Now, why is this such a common question? It's because prior to utilizing the wave principle, most traders have gone through different trading methodologies or strategies where they're looking at indicators and candlesticks and so on. And of course, I'm going to switch to a candlestick chart. The time frame that you see a daily candlestick on, if I change the time frame, so for example here, it's so obvious in hindsight, right, in the dollar index, this is such a bearish looking candlestick pattern. If I only paid attention to that, I could have caught a big drop in the index. Well, who's to say that the daily chart is the best place to look for this candlestick pattern? Is it maybe the 4-hour chart? Oh, but now the candlestick pattern's not as obvious. I guess you have this, this bar here that looks pretty ominous, but it doesn't look quite as distinctive as this sell-off here. This doji followed by this engulfing candlestick right there, or outside bar. I'll be the first person to say I don't care what the names of these patterns are. I don't know them all that well, but I do know that most people would consider this, in terms of candlestick analysis, to be a very bearish formation. But who's to say that it's most obvious on the weekly time frame, or is it more obvious on the on the daily time frame? or the 4 hour, the 1 hour. And it's the same thing with moving averages. Now see here on the weekly chart, now this candlestick pattern looks pretty ominous, but at what time frame do these candlestick patterns work the best? And the answer is I don't know. I don't know. But here we have a bearish moving average cross, and that took place in August 2020. But if I go to the daily chart, the moving average crossover, took place in May of 2020. So here again we have a cross that took place in August of 2020, and then here we have a cross that took place in May. So if you were using the daily time frame, you would have caught the crossover much sooner. On the other hand, if you were using the weekly chart, you would have stayed in the trade all the way down. The moving averages here, they never crossed bullish. But on the daily chart, they did cross bullish. We got a bullish cross here, somewhere in the middle, back in October of 2020. So, maybe you would have gotten out of the trade on that bullish cross and then you wouldn't have gotten back in. Or maybe you went long and then you got stopped out. The point I'm trying to make is that time frames skew the decisions that you may or may not make when you're using indicators or candlesticks or anything that's dependent on the price action changing. But with the wave principle, a 5-wave move is a 5-wave move regardless of time frame. A 3-wave move is a 3-wave move regardless of time frame. So no matter how I use time frames or indicators or whatever I want to do, I will count this as a 5-wave impulsive advance. Again, whether that's on a daily chart, a 4-hour chart, a 1-hour chart, a 15-minute chart, it doesn't matter. The information I'm getting is going to lead to the exact same outcome. And that's why at Parallax, when we're looking at markets, our primary source of information is always going to be simply the price action, irrespective of time frame. We're here to count waves using the rules and guidelines of the wave principle. Does that mean that we believe technical indicators are useless? I don't think they're useless at all, but I do think that they're probably best utilized in conjunction with something like Elliott Wave Principle. All right. So the wave principle gives us an invaluable piece of information that no other methodology out there can give, and that is context. So what I have noticed, and you can conduct your own studies, the only thing I will ask is that if you are looking to test this, you better be sure that you have the wave count correct. Because if you don't, then any testing you do with these indicators is going to be meaningless. But here's what I've noticed, is that at turning points in the market, okay, places where what's a turning point? Well, the end of a wave is a turning point. So when wave 1 ends, the market's going to trade lower in wave 2. Wave 2 ends, the market's going to start trading higher in wave 3. Each of those ending waves is a turning point. So what I've noticed is that at turning points in the market, based on the wave principle, that's where you can expect to see the indicators give the most accurate signals. So what's an example of that? Well, here in the dollar index, let's just take a look at this wave 1. Now, if I bring up my momentum studies, I can see that the RSI was overbought at the end of wave 1. I might get an overbought signal prior to that, but I can't count 5 waves up at that point. So I know that that is not the end of the trend. On the other hand, if I wasn't using the wave principle and I just saw this, the RSI being overbought, and I saw the scary looking bearish candlestick right here, I'm going to zoom in a little bit, I might go short the market. But I wouldn't understand, without the benefit of the wave principle, that I'd be shorting a corrective pattern, which is eventually going to get fully retraced, which means we're going to go on to make at least one more new high before wave 1 completes. So with the benefit of the wave principle, this is a signal that we would ignore. We would focus on the validity of the signal as we're approaching a turning point in the market. All right, and it's not coincidence that that is where the MACD also makes a bearish cross. The end of wave 1. As wave 1 ends, we get that bearish MACD cross. We also get on the daily chart that bearish candlestick formation I was referring to earlier. We're also likely going to get at some point a moving average cross. In this case, on the daily chart, it didn't occur until well after the move was already underway. So I grant you that's not the best example there. Let's look at Bollinger Bands. Yes, we started to tag the upper Bollinger Band and give these ominous looking candlestick readings near the upper Bollinger Band as well. What about the Ichimoku Cloud? Well, all right, that one didn't really work all that well either. We didn't break through the cloud until we were well below. So this goes to show that not every indicator is going to give you the most accurate or the most timely signals all the time. But if you do use indicators, my opinion is that the most accurate signals will be generated at turning points in the market determined by the rules and guidelines of the wave principle. So now let's look at this wave 2 right over here. We're going to apply the same methodology. Now from an Elliott wave perspective, I'm just going to switch to a bar chart here because it's cleaner. Wave 2 is going to be a 3-wave setback. In Elliott wave terms, this setback is known as an ending diagonal, as a zigzag. So this 3-wave setback is called a zigzag, A, B, and C. So if I had to use my labels here, this is what it would look like. A, B, and C. And wave C of this zigzag is an ending diagonal, for those of you that are curious or want to know more about the wave principle, which I always love to see. So we know that wave 2 is going to be a 3-wave setback, and we know that it cannot exceed more than 100% of wave 1, which is right here. So let's take a look at our momentum indicators. Well, the RSI doesn't tell us much on the daily, but we get a bullish cross in the MACD. We get a bullish moving average cross not too long after the bottom of wave 2, which would position us nicely to capture the heart of wave 3. Let's see. We get we get here exhaustion along the lower Bollinger Band, followed by a strong Bollinger Band breakout. A Bollinger Band breakout occurs when the Bollinger Bands contract. In other words, the space between the upper band and the lower band becomes minimal, and then we get a strong bar closure above that upper Bollinger Band in terms of dealing with a bull market, that is. All right, from just pure candlestick analysis, you can see here a visible decrease in bearish momentum. Here, we start seeing more bearish candlesticks with a couple bullish candlesticks. And then here in the late stages of wave 2, we're getting a mix. You know, we have a down day, an up day, a down day, an up day, 2 little down days in a row, big up day in a row, right? So we're starting to visibly see that decrease in bearish momentum. So candlesticks, the Bollinger Bands, moving average crossover, the MACD crossover, the Ichimoku Cloud. Again, same thing. We get a breakout of that cloud, you know, as we launch into the heart of wave 3, which is what we want to be capturing as wave traders most of the time. And we can just do this over and over and over again. You know, we can move to a different market here. We're going to take a look. Let's look at the Australian dollar, US dollar. So what's the turning point? Where I have this X wave label is a turning point. We got a very bearish candlestick pattern there on the daily chart. What about moving average crossovers? Yeah, this one's a little bit late. Now, I'm just throwing up random moving averages here. This is a 20 and 50. And that's the other thing. How do you know which settings to use for your indicators? I usually just look for the most standard ones because I don't think there is such a thing as a perfect indicator. Bollinger Band, yep, we pierce the upper Bollinger Band. RSI gets nearly overbought. We get a bearish MACD cross. What about the Ichimoku Cloud? Yeah, we break through the cloud pretty late as well. You know, but if I change my time frames, I'm sure I would get a more timely signal. See, we get a more timely signal there on the 4-hour. We get a more timely moving average crossover on the 4-hour as well. All right. So these technical indicators can be very helpful, but in my opinion, they're most helpful when combined with the wave principle, because the wave principle is going to give you context. So there's no other methodology that can answer questions like, is this an old trend? Is it a new trend? How much further do we have to go before this trend exhausts itself? You know, there's no other methodology that can pinpoint very specific price levels based on Fibonacci calculations like the wave principle can. So some other tips and tricks that can give you context, sure, could be support and resistance, supply and demand levels. So for example, here's just a very obvious, resistance level. We pierce through it briefly before breaking back down. So that can give you some context as to where to look for reversals, but just using support and resistance or supply and demand levels is not going to tell you how far something's going to go, why it's going to go that far, and what's going to happen afterwards. Sure, I can say we're going to at least test this prior support level here, but what happens after that? Again, I don't know of any other methodology other than the wave principle that can answer that question. So technical indicators, just to recap, they have a place. All right, as you can see, I use the MACD and the RSI quite frequently. Those are the two that I use in conjunction with the wave principle. I don't need moving averages or anything else. I just rely on my momentum studies to help validate what I'm seeing as far as the wave count goes. But if you wanted to use moving averages to introduce a more mechanical element to your overall trading plan, that's perfectly acceptable. Bollinger Bands, candlestick analysis, it doesn't matter to me. What matters is that you recognize that those are simply tools. And the best way to identify the job at hand, the market conditions at hand, is to use the wave principle. So use the wave principle, determine what the market is doing now, what it's going to do next, and then you throw on your indicators to see if they provide supporting evidence. Keyword there is supporting evidence. So I hope this was helpful, gives you a bit of an insight into how you can utilize technical indicators the best. And my answer, kind of tongue-in-cheek there, is learn the wave principle first. Master the wave principle, and then figure out which indicators are best going to suit your personal trading style. And if you want to learn more about the wave principle, please drop a like, drop a comment, subscribe, ask us questions. We're here to help you. This is what we do. This is our passion. We talk to people about the wave principle day in, day out, every single day of the week, no breaks. So thanks. See you guys soon in the next video.